What's up, you guys? It's Mike here, and in today's video, I want to discuss why multifamily investing is the best investment out there. So let's jump into it. All right, guys, so a couple things I want to break down here on multifamily investing is why I believe it's so powerful. The number one thing with real estate in general is leverage. Leverage is powerful, especially in real estate. When you buy good debt, which buying real estate is good debt, especially when you rent out those units and the tenants pay down your debt for you, you also get the four main things in real estate. So you get to leverage your debt, you get the appreciation, you get the tax benefits, you get depreciation, and then if you run the property correctly, you also will get cash flow. Cash flow is extremely positive, so let's touch on that right away. So cash flow in multifamily investing or in real estate investing is ultimately what can set you free. It's what makes real estate amazing, is that you get those other four main benefits and then you get cash flow. If you ultimately buy enough real estate that creates enough cash flow, this is where you can actually retire at a young age. Like, I'm 30 years old. I still have a job as a mortgage lender, but my passive income from real estate investing, the cash flow, is well above my expenses, so I could retire today if I chose to do so. I don't choose to do that. I like to still help people with mortgages. I also like to flip properties, buy more properties, but it is something that I could walk away from today and just have time freedom and do whatever I want. Let's also touch on depreciation. So depreciation is actually a paper loss. And what's so cool about it is that for a single family property, let's just use a 4-family, for example, whatever the property's worth, so let's just use easy numbers. If it's $275,000, you can write off 27 and a half years every year. So you would actually show a $10,000 loss that year. And that's a paper loss. That's just writing off the building against depreciation. You can also write off your expenses. So for all the landlords out there, you know that, properties, they always have things that come up, whether it's, toilets or windows or tenant turnover, and you have to spend money to keep your building up to par. You got to get the grass cut. You got to do multiple different things that cost you money every year. And that's all tax deductible. That's a business expense, so you can write that off. So let's just say, for an example, you spend $1,000. So now you have a $10,000 write-off in this example, plus an extra $1,000 for all your expenses for the year. So now you're at $11,000. The other thing that's so amazing about real estate is that you can write off all the interest on there as well, because that is an expense. So let's say, for easy numbers, you have a $1,000 payment, and let's say 500 of it is the interest and 500 of it is principal. So now that's another $6,000 you get to write off for the year. So now you've written up to, you're at $17,000 that you're writing off. And here's what's so powerful about it. So let's say you make $1,000 or $1,500. Let's say you make $1,500 a month, and that in net cash flow. So you made 18 grand on that one building, but let's say you incurred $18,000 worth of expenses, whether it be the depreciation. Let's say you had $2,000 of expenses, and then you have $6,000 worth of interest. So that's 18 grand. That means that you will pay zero taxes on the $18,000 in cash flow that you made. That is just absolutely incredible. And you can see the power of this. That's one 4-family. Let's say you have 2, 3, 4, 5, 10 of them, and they're all making you 18 grand a year, but you incur at least $18,000 of expenses. Theoretically, you could make $180,000 a year if you had 10 of them, and you could pay zero tax on that $180,000 a year, which is absolutely extraordinary. The other thing that's amazing about real estate is the appreciation. Many of you in today's market, you've probably seen that 2 years ago, a house might have cost, say, $300,000, and in today's market, it's worth $350,000. Well, there's many factors that go into that, but the easy one to talk about is just appreciation. Property values have gone up because every year, historically, real estate goes up. I mean, it's like any market. It'll have ebbs and flows throughout the time of you hanging on to it, but over time, you're looking at a 3 to 5% of appreciation yearly. And then you get into a volatile real estate market like today, where the supply is low, but the demand is high, and that actually causes prices to go up, just simple supply and demand. So prices are probably at an all-time high right now, but you're still able to get that appreciation. And when you have times like this and everything's really on the high end, it is a huge benefit for if you are owning assets, especially real estate for this example. So you could actually sell your property. Let's say you wanted to just 1031 it, or you wanted to sell your property just because you wanted like a large lump of cash flow or cash, like a cash injection into your business. You could sell it. Some people bought properties 2-3 years ago. The appreciation went way up. Their tenants paid all the mortgage down, so you didn't have to pay for any of it either. And they make, $100,000 just because it went up in value so quickly. And then they can do whatever they want with that money. They could 1031 it and go buy more real estate. They could just take it, pay taxes on it, and just put whatever was left over in their bank account, use it for anything that they want. But that's the power of real estate, especially on the multifamily side. So let's talk about some other benefits of, say, a 4-family, 8-family, whatever it may be, is that what I really enjoy about more than one door, so let's just use a 4-family again as an example, is that if you lose one tenant, you still have 3 other tenants paying for your mortgage and your expenses. And if you buy these properties right, generally speaking, about 2.5 tenants out of your 4 should cover your expenses. So if you have 3, you should still be net cash flow positive. If you have all 4, then you take the, obviously that 4th unit is 100% profit, and you get a little bit off of the other tenant. And there's many smart ways to make sure your building is full at all times. One of the easiest ways to do this is to just have stagnant leases. So never have 2 leases coming up at the same time if you can control that. What you'd like to do is have, 4 leases that come up at different times. That way your building won't go completely vacant all at once and you'd have to find 4 new tenants. That's a really good way to do it. That's the way I've done it, and it's worked out extremely well for me and for my business. And I think that finding 1 new tenant is a lot easier than trying to find 4. It's a lot less stressful. And also, that if you don't have that 1 tenant and you have to find a new tenant and it takes a little bit, you still have the other 3 that are paying for your mortgage and your expenses and all that good stuff, so that you're not coming out of your own pocket to pay for your building. Now, the other thing that I really like about multifamily investing, especially on the larger scale, so anything 5 units and above, is it's considered a commercial property. So the value of the building, the biggest difference between single family and multifamily, or single family and commercial, is commercial, the building is worth what it's generating. And then there's a cap rate that goes along with that. So for, real easy numbers, if you have a 10 cap on a building and it's producing, certain amount of money, it's going to be worth X amount of dollars, and it's all based on what it's generating. So if you buy an 8-family, for example, and the rents are really low, like at $400 across the board, say all 8 units, and let's say you buy it and you renovate it, you put a couple $100,000 into it and you raise the rents to $800, now that building is going to have a completely new value based on what it's generating in income, not based on what the sales comparables are around it. That is one approach that they look at, but that's not the only approach that they look at. Now, in the single family world, between one door or 1 unit to 4 units, they're going to be looking much more on what the sales comparables are around there. So in the sales comparables, those are really going to have to do with, like, let's say your neighboring property sold for $300,000. It's going to be really hard for you to sell your property for $400,000 or have it worth $400,000 if nothing else around there is selling for that. But it's just the opposite in the commercial world. If you happen to run it better and you have better tenants that are paying more money, the other building down the street could be an 8-family, but it might only be worth on paper $300,000 or $400,000. But let's say you're getting double in rents, your building could easily be worth $700,000 or $800,000 just because you're running a better operation and you have nicer units for your tenants. So I highly encourage everybody that's not in multifamily investing to start looking at getting into it, because cash flow, positive, passive cash flow will change your life. Real estate appreciation will change your life. And once you understand all the tax benefits and also the depreciation to go along to offset taxes and to help you get ahead in your life, you're going to fall in love with real estate, similar to how I have and many other investors out there. And the other thing is, guys, is this stuff is not rocket science. A sink is a sink, drywall is a drywall, a toilet is a toilet. Once you understand the financial aspect of this, and you're willing to go all in and you're willing to learn, and also with learning comes with making mistakes, but you can minimize those mistakes and you can learn and not make the same mistake twice, you're gonna just absolutely fall in love and become obsessed with investing in real estate. And hopefully you'll just dive all in and you can get yourself to a point where that positive cash flow is coming in every single month. You can still work your job or do what you love or whatever it is, because at the end of the day, the way I look at this is it's not all about being super rich or wealthy and all that. It's about buying back your time. And when you buy back your time, you can hang out with the people that you love. You can do what you love. You could leave that job that you hate. You could go out and help people. Whatever it is that you want to do, you can do it. But if you don't set yourself up for success and you don't get yourself there, then you're never going to be able to do those things in your life. And you're always going to be a slave to either a job that you hate, or maybe you love your job, but you don't have enough time freedom with it. Really what this does is it gives you options. And in life, when you have options, everything becomes better for you. So I hope you guys enjoyed this video. I'm going to release more videos like this touching on multifamily investing. I'll still talk about mortgages. I'm doing a flip right now. I'll add more videos to the flip and kind of show you guys just a different side of investing, because I like buy and holds, but not every deal is a buy and hold deal. It's some of them, especially if it's one door, I will buy it and I'll put the work into it and I just sell them for the profit and hopefully a profit, and then continue to push on and go find more doors and more buildings that I ultimately want to hold on to. So thank you everyone so much for watching. If you have questions, drop them in the comments below. Please give me a thumbs up on this video. I'm trying to grow this channel ultimately to just give you guys all the golden nuggets that I've learned, and to hopefully help you guys build a massive passive income through real estate investing. So thanks everyone, and have a great day.